Starbucks reported earnings yesterday and the stock price went down about 16%. So what happened? Is there an overreaction or are they really in trouble? Let's find out in today's analysis. Starbucks stock reported an EPS of $0.68, missing analysis estimations by a decent amount. Revenue was reported at $8.56 billion, also missing the analysis estimations. But especially comparable sales is what worried most investors. More on that in a minute. People love Starbucks stocks for different reasons, and one of them is the dividend. And I understand why, with dividend yield at 2.6% and 13 consecutive years of dividend increases. If we look at the total returns in the past 5 years, we see that Starbucks stocks massively underperforms the S&P 500, and this is including dividends. So, could this be the perfect time to buy Starbucks stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does Starbucks do? Starbucks is the most widely recognized coffee chain brand in the world, operating stores across more than 80 countries. Diving into the earnings, we see that revenue was reported at $8.6 billion, down 1% year over year. To me, this doesn't look good. 74% of the revenue is coming from North America and 21% is coming from the international segment. Looking at the North America segment, we see that revenue was flat year over year, but comparable store sales decreased 3%, driven by change in transactions. And keep in mind, last year the comparable store sales were at 12%. This is what worried most investors. Store went up 3%, which is nice, but the fact that operating income and especially the margin is what worries me a lot as well. The international segment decreased 6% in comparable store sales, while last year it was at 7%. Store count increased with 9%, which is a big number. However, revenue decreased 5%. And looking at the margin, I really get sad. It decreased with 370 bps. The last segment, channel development, is looking the worst with a revenue decrease of 13% and margin decreasing with 280 bps. Overall, we see comparable sales decreasing with 4%, but China is really disappointing with minus 11% in the international segment. For the full year guidance, Starbucks expects the comparable growth to be in the range of low single digit decline to flat numbers. To me, this doesn't look any good. New store growth is expected to be at 6%, and especially China is expected to grow a lot. This should catch up a little bit for the comparable growth. Global revenue is expected to be in a low single digit and margins to be flat. The full year EPS is expected to be flat to low single digit growth. And overall these earnings were really bad in my opinion. But is it minus 16% in stock price bad? I don't think so. So let's check the fundamentals to see where the company is at right now. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. Starbucks stock is a 84 billion market cap company. PE ratio is at 19.7, indicating they could be undervalued right now. Later in this video I will show you my 3 price targets for Starbucks stock, so make sure to watch until the end. Revenue is at 36.7 billion, and in this graph we see that revenue went up at a pretty steady and consistent pace. Of course, we see the impacts during the lockdown periods. Yesterday's numbers aren't processed yet. Margins are going up in the long run, and this is really important to me. However, it is not really steady and consistent pattern, and after yesterday's results we see that margins took a big hit. EPS is looking pretty good. In the long run it is going up. The only thing is that I do prefer a bit more steady in pattern here as well. Analysis expected EPS will increase at a high pace, around 18% per year. It is expected that they will reach $8 in 2028. For the revenue analysis, expect also pretty high numbers. On average, you're looking at 9 to 10% growth per year, and it is expected to reach $59 billion in 2028. Return on assets is sitting at 14.6%, which is a great number. Return on equity looks really bad, but the most important number, return on invested capital, is sitting at 70%, which is a really great number. It is also higher versus the 5-year average, which is a good thing. Current ratio is at 0.7, which is a decent number. Nothing really special to mention here, to be honest. Right now, Sbux has $25 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Sbux has $3 billion in total cash, so they can't pay down all their debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run. However, it is again not really steady and consistent. We also see the impact during the lockdown periods. Shares outstanding are decreasing, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 2.6%, which is a great number. Annual payout is at $2.28 and payout ratio is around 60%. I prefer 50% or lower, so right now they have 40% left in cash to buy back shares, pay down debt, do acquisitions and all other things. The 5-year growth rate is at almost 10%, which is a great number. On top of that, they increased the dividends for 13 years in a row. And if you take a look at these numbers, the dividends paid since 2012, you see that Sbux did increase the dividends at a high pace. However, most recently, growth is starting to slow down a bit. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. And here we see that payout ratio is really steady and consistent around 50 to 60%. I would prefer 50% or lower, but I'm okay with the current situation. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation that can be highly impacted by results, but it gives you a rough indication. It is expected to increase at a higher rate versus previous years. Overall, these dividends look really good to me, but how about the historical returns? I decided to compare Sbux stock with the overall market, in this case the S&P 500. Next to that I added Dutch Bros, another coffee chain company. On the 5-year chart we see that Sbux underperformed the S&P 500 big time, with only 26% return, and this is including dividends. The S&P 500 returned 85% and Dutch Bros returned minus 23%. On the 1-year chart things look pretty interesting, with Sbux sitting at minus 21%, while Dutch Bros is sitting at minus 9%. The S&P 500 however is sitting at a 23% return. On the 6-month chart it is again Sbux that is having a negative return. This time it's almost minus 4%, while the S&P 500 is beating them again with 22% return. On the 1-month chart it is again Sbux stock that is losing big time to the S&P 500. Bottom line, Sbux was beaten in the long run and in the short run by the S&P 500. So could this be the perfect time to buy Sbux stock? Well, let's check the 3 price targets that are created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 10, 11 and 12. For the free cash flow margin I'm putting in the same numbers. For the PE ratio I'm putting in 20, 22.5 and 25. For the price to free cash flow I'm putting in the same numbers again. In my opinion, Sbux has a big moat, so I'm willing to pay a premium for that. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now Sbux stock is around $73. I hit analyze and we see a lot of red numbers. We have a low price target of $49, we have a mid price target of $67 and we have a high price target of $92. And to me the high price target is still the most justified here, meaning the stock is undervalued based on these numbers. So what do you think is the most justified price target here? Let me know in the comments down below. My final conclusion on Sbux is that I love the company. After yesterday's results I think we are seeing an overreaction. There is a lot of pressure on comparable sales and because of that also on the revenue growth. Margins are also not looking good, but I still think Sbux could be a great play in the long run. Most fundamentals look pretty good and they are a solid dividend payer. To me, this looks like a short-term problem that they will fix in the coming quarters. Maybe not in the upcoming quarter, but they will recover. Sbux is a strong brand and has a strong moat in a lot of areas. On top of that, they are expanding rapidly. For now, I'm buying more stocks. Last month I bought around $85 and nearly doubled my position. Of course, with yesterday's results the price target changes, but I still think Sbux is undervalued. And because I think it is an overreaction, I will buy more in the coming period to average down my cost. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.